Good morning. Welcome to Stock Market Today and happy Friday. It's Friday, December 14th, 2018, and I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can follow me on Twitter. I'm at DanRusso_CMT. If you're on StockTwits, I'm there as well under the same handle. Stock Market Today brought to you today and every day by Chaikin Analytics. And if you head over to chaikinanalytics.com/today, you can sign up to receive a free email with daily stock ideas. And you'll also be able to follow along with this show. So if we dive right in, U.S. equities were mostly lower on Thursday. Materials, financials, and consumer discretionary were the worst performers. The defensive sectors led, staples, REITs, utilities. Treasuries were mixed with the curve steepening. The dollar was better against the yen and euro, but weaker against the sterling. Gold down 20 basis points. WTI crude up nearly 3%, up 2.8% on the day following some reports of lower U.S. stockpiles and possible Saudi import cuts. Breadth on the New York Stock Exchange was negative 1.8 to 1. Breadth on the NASDAQ negative 2.8 to 1. And as we arrive at the desk this morning, futures are under pressure. S&P futures down 90 basis points, though off the worst levels of the morning. Asian markets were weaker overnight. Japan, Hong Kong, China all down at least 1.5%. European markets are under pressure as well. Treasury is stronger across the curve. Dollar seeing good gains against the euro and sterling. Flattish against the yen. Gold off 40 bips. WTI crude giving back 60 basis points here this morning. To me, when you're looking at a daily chart of the S&P 500, you can carve out the key levels, right? We've done that numerous times. 2630, below that 2750 to 2600 our key support. Your declining 200-day moving average at 2760, and then obviously at 2815, that key breakout level. You can see that clearly. We can draw the lines. We can do that. What's interesting to me is digging in under the hood. For the past 4 days, the market has tried to rally and been sold off to varying degrees. Sometimes we've closed up on the day, as we did on Wednesday. Sometimes we've closed lower. But early rallies in the market are being sold. That's information. That's telling you that the bears are still in control here. Just as daily rallies to resistance are met with sellers, intraday rallies are being met with sellers as well. Markets are fractal. It's a dynamic of what's taking place. What's going on the daily basis is a reflection of the larger trend. At best, we're in a range. Until we get above 2815, the bears are in control. That is the key level. RSI remains in bearish ranges. Chaikin money flow, still bullish, but not as bullish as we were 2 weeks ago. Keep an eye on those indicators. Support remains in place. 2630 being tested here this morning with the futures down close to 1%. Below that, we'll see how we react at 2570 to 2600. Market in a minute. Here's what I'm talking about in my note to Chaikin Analytics members today. Once again, an early rally fades into the end of the day. We talked about that. Defensive sectors lead and small caps continue to break down. I've shown that chart numerous times. Excuse me. We've seen it. We know it. It's getting worse. Risk off remains the message from key market relationships. We'll take a look at that today. We continue to favor low and minimum volatility for long ideas, and futures do point to that lower open. So diving right in to the power bars for the major indices, 1, 2, 3, 4, all skewed to the bearish side. 2 to 5 for the Dow, 43 to 111 for the S&P 500. NASDAQ, slight, ever so slight outperformer yesterday, still skewed about 2.5 to 1 in favor of the bears. Look at the small cap underperformance. As I said, it's getting worse. Take a look at my note today where we look at small caps relative to the overall market, key themes and relationships. That's if you're a Chaikin Analytics subscriber. You'll see the breakdown there. It's pronounced and it's getting worse. 149 bulls to 483 bears. Bonds down tick slightly. According to the Chaikin Power Bar, small cap stocks and large cap stocks remain bearish. Major indexes are all bearish. Now, our stock of the day today is one that really is going to provide a good lesson for us. Express Scripts, very bullish stock due to very attractive financial metrics and strong earnings performance. Closed at 98.95, up 2.08% yesterday, so big outperformer. Very bullish stock leading the market, and it really has been a leader for most of the past 12 months. Dynamic duo in gear, market and model are in agreement. Nice trend here above the rising long-term trend line. What bothers me is this money flow. It seems to me that institutions are using this strength to come out of their positions, to take profits in a winner. If it was just kind of a slight blip in the money flow like this, I wouldn't be as concerned, like what we saw back here in the summer. But this is persistent bearish money flow. I think that if you want to look at Express Scripts, you can, because it's a very bullish stock that's outperforming the market. But I want you to be aware of the risk. And the risk here is that institutional investors are booking profits into the end of the year in a name that's been a big winner. Keep it in mind. Chaikin money flow tells you or gives you a read on what the institutional investors are doing. And we're going to have a great example of that a little bit later in the show with a different stock. Sector movement over the last 5 days still favors the defensives, utilities, staples, and the comms, as well as healthcare. Real estate backed off a bit here. Financials continue to be under pressure. Industrials and materials continue to be victims of the rhetoric around the trade war. Tech, energy, discretionary, middle of the road for now. Key theme, defense is the name of the game right now, especially with only a couple of weeks left in the year. Our industry in focus is telecom services, which over the past 6 months has underperformed the S&P 500 by 1.9%. Its power bar ratio, which measures future potential, is weak, with more bearish than bullish stocks. But really, 8 to 9, we're kind of even. And as you can see, it's currently ranked number 4 of 21 subsectors that we look at. Indicative names there. Iridium, IRDM, very bearish stock. Boingo Wireless, ticker symbol WIFI, as well as Zayo Group, ZAYO. But I'm going to give you a little color here. Read the news headlines. Look at what's going on. Don't just blindly go out and take bullish or bearish positions in a stock. Take your analysis a bit deeper. And when you do, you'll see that Zayo is a rumored takeout candidate. It is a very bearish stock because our model, looks at those 20 factors, and obviously takeout rumors are not one of the factors, but you need to be aware of it. If you're short Zayo or have a bearish position in Zayo, and there's an announcement that they're going to be taken out, you are going to lose money for a silly reason because the rumors are out there, the headlines are out there. Factor it into your process. We're going to look at Boingo Wireless because it's a great example of what I was talking about in Express Scripts. Very bearish stock, weak trend, weak industry group. Underperforming the market. Market and model are in agreement. Dynamic duo are in gear. Unfortunately, we are oversold. I want to see this stock rally back to the $24 level, become overbought. Then I want to open a bearish position. But look at the lesson. Remember what I was talking about with Express Scripts. Look back here. Near the highs, bearish money flow. The institutions were coming out of the stock. Look at here. Look at Wi-Fi. Near the highs, bearish money flow. The institutions were coming out of the stock, and it cratered. That is what I'm talking about. Institutional investors are using strength to come out of their stock. They were doing it here in Wi-Fi. It appears that they're doing it in Express Scripts. Keep it in mind. I'm always here to help. Ping me if you have any questions. Trending names now. Yesterday's S&P 500 movers and shakers. GE, the big story yesterday, up 7.3%, was actually up over 11% at one point during the day. Long-time bearish analyst at JP Morgan upgraded the stock yesterday, saying the risk-reward is more balanced now. Keep in mind, he upgraded it to a hold rating, but he had been underperformed, so kudos to him. Great call, taking advantage of the weakness and upgrading his stock. AFL up 6.6%. Japan Post Holdings reportedly looking at taking a minority stake. That sends that stock higher. Kimberly-Clark, defensive name, consumer staples, company, that up nearly 4%. Macerich was a bearish name for us in real estate, which is a defensive group which has been outperforming. We covered our bearish position for our bearish insights readers, made a profit, and look at what's going on now. 2 days in a row, this stock has been on the winning side of the board. And now there is a rumor that they're in play. Possible takeout candidates, SPG, Simon Property, has come out and denied that they're looking at Macerich, but the rumors are there. I don't see it, so we covered that position. So great job to our clients who made money on that trade. Yum Brands up 3%. No real news to send that stock higher. Monster MNST was initiated with a sell rating. HBI, no real news, sends that stock down. Negative comments out of a big investment bank sent American Airlines down 5.5%. Mattel down 5.2%. I can tell you that as the father of 2 young daughters, for the holiday season, they're not looking for toys. I think these traditional toy companies are going to be under a lot of pressure. Kids are going electronic, and unless these toy companies can adapt, they're going to have a hard time. Mattel down 5.2%. Follow through in Under Armour. That stock down 5.25% after being down 10% the previous day following comments at their analyst day. Defense remains the name of the game. Here's real estate relative to the S&P 500. It has made the turn. It's outperforming. It's above the rising 200-day moving average. The RSI of the ratio has shifted into bullish ranges. And now even on an absolute basis, we have a breakout. We're retesting that breakout level. But real estate in an uptrend on both an absolute and relative basis as investors continue to position defensively. Defense remains the name of the game. I could have easily used utilities. I could have easily used consumer staples. I could have easily used healthcare. Those are the sectors that are outperforming in this environment. Flip side of that, and here's where we are going to use consumer staples, is that risk off is the key message from the market. What I'm looking at here is the ratio of consumer staples to consumer discretionary, which if you think about it, does speak to risk on, risk off, right? Even if if the economy's slowing down, if we were to go into a recession, your consumer staples, your Colgates, your food, you're probably not going to stop buying that stuff, but your discretionary, you might trade down or look for areas to cut back. That's why this chart speaks to defensive positioning. Made the turn above the 200-day moving average. Breakout, retest, and rising once again. 200-day moving average shifting from declining to flat. Actually looks like it's beginning to turn higher. RSI of the ratio has moved into bullish ranges. And look when the outperformance started. Started to turn higher right as the S&P 500 topped. And as this ratio moves higher, the S&P 500 is moving lower. This ratio is a very good tell for the potential future direction of the market. There's clearly an inverse relationship there. We still prefer low volatility to high beta. Here's SPLV, the Invesco S&P 500 low volatility ETF relative to the S&P 500 high beta ETF. Breakout, retest, now off to the races again, above the 200-day moving average, RSI, series of higher lows, and now shifting into bullish ranges. This also speaks to the risk-off nature of the market, but it's also been something we've been talking about. When the market cracked 28.73 to the downside, we started talking about positioning more defensively. And what we said at the time, we've said it on this show, we've said it in our open forum calls, I've written it in my notes to clients. For your long ideas, favor the names that have a beta that is less than that of the market. And for your short ideas or your bearish ideas, look for the names that are high beta. Insulet, PODD, very bearish stock, weak trend, weak industry group. Oversold with bearish money flow, underperforming the market, triggered 2 of our sell signals today, a money flow sell and a relative strength breakdown signal. This stock has a beta of 1.7. High beta name, setting up for a bearish trade. I will see you here on Monday. Have a great weekend, everyone.